Good afternoon, everyone, and welcome to our annual Proxy season preview. My name is Gordon Raman, and I'm a partner in Fasken's Capital Markets and M&A group based here in Toronto. I also chair our firm's ESG and sustainability practice. On behalf of all of my colleagues at Fasken, I'd like to wish everyone a very happy new year and tell you how delighted we are that you could join us for today's presentation. I should note that this is a hybrid event. So in addition to all our guests in the room, we have about several hundred people online. So to all of you, welcome. For those that have joined our annual Proxy season preview, you'll know that we generally have two panel discussions. Traditionally, in the first panel, we've talked about regulatory updates, governance updates, disclosure updates that public companies should keep in mind as they prepare for Proxy season. And in the second panel, we like to delve into a topic in more detail, something that companies should be thinking about. This year, when we were planning our session, we realized there's probably two important topics for public companies to keep in mind. And we're going to delve into both of those topics in our panel discussion. So what does that mean for our traditional regulatory updates and our disclosure updates? Well, last week, we published a comprehensive bulletin that outlines all of the significant developments from last year that public companies would want to refresh themselves on and review before they prepare for Proxy season this year. If you haven't received a copy of that bulletin and would like to do so, please visit our website. For those in the room, if you scan the QR code at the registration desk, you can download a copy of the bulletin for yourself. In addition, I should note, yesterday was also the release of our Fasken 2024 ESG disclosure study. This follows on our inaugural study from last year and covers ESG disclosures by large public companies and is a guide to public companies as they prepare their ESG disclosures in the coming year. Again, that's available on our website. And for those in the room, you can scan the QR code at the registration desk and download a copy. So what are the two topics that public companies should be thinking about this year? First, business and human rights, and in particular, the Forced Labor, Child Labor Act that just came into force at the beginning of January and the reporting regimes around that. That's what we're going to cover in the first panel. And in the second panel, we're going to cover climate change. I know people have been talking about climate change for a long time, but climate change and climate disclosures in particular. So without further delay, let me introduce our first panel. To my immediate left is Claudia Feldkamp. Claudia is counsel at Fasken based here in Toronto. She advises clients on corporate law matters, specializing in governance, anti-bribery and corruption, and evolving domestic and international compliance and reporting standards in the areas of corporate social responsibility, international trade, and investment law. We also have Chris Pigott. Chris is a partner in our labor, employment, and human rights group based in Toronto. Chris provides companies with strategic advice on employment, human rights, and public law issues. Chris has been recognized by Chambers Canada as a lawyer with, quote, a wealth of legal experience and knowledge. So Chris, we're going to benefit from all of that today. And we also have Cliff Sosnow, a partner based in our Ottawa office. Cliff is the chair of Fasken's International Trade and Investment Group. He is an internationally recognized trade, investment, and anti-bribery law advisor and a strategist helping clients navigate all of these complex issues with clarity. So to our panel, welcome. When we kick off the topic of business and human rights, Claudia, I'm going to turn to you first. I think the road to this discussion really begins at the UN guiding principles on business and human rights, but I don't know if a lot of people are familiar with what that is, what it entails. Can you give us the context of what that is? Can you start this off for us?
Sure, happy to do that. Hold my mic at the appropriate distance. So we have this new legislation, as Gord just referenced, and this legislation doesn't really come out of nowhere. In fact, it has its roots really in a very broad international consensus around the obligation of businesses to respect human rights. And that consensus is reflected and has coalesced around the UN guiding principles. And so the UN guiding principles are really key for us to understand what governments are doing, why they're doing it, where it's coming from, but also what businesses need to know in terms of their own compliance, both with the guiding principles, but also specifically with law and the new laws that are coming into play and knowing what may be coming down the road.
I was taking my watch off so I could make sure I monitored our time. I didn't mean to distract you. I'm gonna get to the, there you go.
Okay, perfect. I don't know if I'm now interrupting you. You might have another question for me,
No,
but I was just
you
going
go right
to,
into this.
I was going to move right into the UN Guiding Principles on Business and Human Rights. This is sort of the global standard in terms of our understanding of what businesses are obligated to do or expected to do. And it's around the UN Guiding Principles that really this international consensus has coalesced. And they are not new. They've been around since 2011. And so there has been sort of lots of activity in the area. But one of the key things to remember around the UN Guiding Principles is that it defines for the first time an obligation for business to respect human rights. And at the core of that is a requirement that you engage in mandatory, or sort of, I shouldn't use the word mandatory, but to use human rights due diligence in order to be able to identify, mitigate, and then provide remedy where there has been a human rights violation. And that obligation for business it was a new sort of way of defining it for business, but it's alongside the state well-known obligation to protect human rights. This is longstanding, but it's key to here because what Canada is doing in terms of reporting legislation, what other jurisdictions are doing, including mandatory human rights due diligence, that flows from this first pillar, which is the obligation for states to put an appropriate law, regulation, and policy in the area of business activities to ensure that human rights are respected. And I'll just highlight the third pillar. So the first pillar is the state, second, the business to respect, and the third is remedy. Both business and states have the obligation to provide access to remedy, and we'll link back to that when we talk about core.
Okay, so we have states that have an obligation to enact laws. We have businesses that actually have the duty to comply with those laws and respect business and human rights. So let's start digging into this a little bit. So there's been this evolution. So we've had the UN Guiding Principles for about a decade. And in that decade, there's been this general process of an acknowledgement that businesses have impacts, non-financial impacts. That's seen in the human rights sphere. It's also seen in the climate change sphere. The first step in this evolution is really around what people refer to as transparency. So disclose things around human rights, disclose things around climate. So that's part of this trend we're seeing. We're also going to touch on these indirect compliance measures. So what are the ways in which governments are getting organizations to comply with some of these requirements? And we're also going to conclude with mandatory due diligence, which is kind of the final step in that second pillar that Claudia referenced. So if we go then specifically to the Canadian legislation, fighting against forced labor and child labor and supply chains, what we have started to call internally the FCLA. Chris, I'm going to turn to you. So there's two fundamental principles and definitions in here. What is forced labor? What is child labor? Can you dig into that for us and then put some context around that and around what the International Labor Organization is and what the genesis of some of these definitions are?
Sure, Gordon. And maybe I'll actually start with the International Labor Organization and what the ILO is, because it's pretty critical to the development and implementation of the FCLA. The ILO, as it is called, is probably the most important international organization that no one in the corporate world has ever heard of. This is a UN agency, essentially, that was established in around 1919, so coming out of the First World War, to really address the human rights impacts of capitalism. And what the ILO does, it is called a tripartite agency. So every year, a group of worker representatives, employer representatives, and governments gets together to set standards in the area of labor, human rights. And, any of the sort of non-financial considerations that really emanate from capitalism and economic development. And so for over 100 years now, the ILO has been setting standards governing things like forced labor and child labor. So concepts, laws, legal standards around forced labor and child labor are not new at the international level. But what we're seeing and what the FCLA does is really import these international concepts from the international realm and bring them into the domestic sphere in a in a legislated way that they just haven't existed in the domestic context. So what are forced labor and child labor? Let me begin with forced labor. It is, I think, kind of obvious from the term. Forced labor really does mean labor that is against the will, desire, against the willingness of an individual to perform the duties that the employer or the contracting party wants that person to perform. So it truly is forced labor, something that that person does not want to do. Typically, forced labor, the test for forced labor is whether this is a service that the individual could reasonably be expected to fear for their safety if they didn't perform. The definitions are very convoluted, both in the legislation and in the ILO standards that they're emanating from. So I think that the bottom line with forced labor is that this is labor that someone doesn't want to perform. Pretty straightforward, at least at a definitional level. Child labor is a bit more complicated because, as everyone in this room knows, there are many situations in Canada and elsewhere where you do see young people working. So, if you walk into just about any grocery store in this country, any convenience store, you might see a 15 or 16-year-old working at the counter. This legislation is not intended to prohibit that. There are really two core components to the child labor definition here. First of all, anyone under 18. Okay, so it's anyone under 18 is the first branch of the test, but that's not it. The second branch of the test really looks to situations that are truly damaging to young people. So situations where the young person would, and the legislation actually says this, would be morally damaged by the work that they're being asked to do. The second situation is really work that would prevent the child from participating in some sort of schooling or educational activities that are important to that child's development. So again, two core components, under 18, and then types of situations that are going to be morally harmful or detrimental to the education of a young person. That's really what this legislation is targeting, Gord.
That's really helpful. I think you covered one of the questions that people often ask: can I hire a young person to work on my factory floor sweeping? Answer is yes, you can do that. The other concept that I think people struggle with is this just some sort of economic issue? Is this like a minimum wage thing? Are you forcing people? Are you just forcing companies to pay more for labor worldwide? Just maybe address that.
Yeah, so in other words, your question is this really just an economic measure in the guise of a human rights measure? Is this just sort of trying to set a minimum standard from an employment perspective? And I think the answer to that is no. When you look back to the ILO instruments that the government relied on when drafting this legislation, and which indeed are referenced in the legislation, you see a focus on really on situations, forms of service that by, I think, any measure are abhorrent, that we could all agree shouldn't be happening. So for example, in the ILO standard on child labor, the types of labor that the ILO is concerned with are things like, and it uses these words, serfdom, slavery, child service that is for the purpose of pornography or prostitution. So really abhorrent forms of service that really aren't directed towards establishing some sort of minimum wage or upward economic pressure on the provision of services.
Okay. So we have a basic understanding of forced labor that somebody does not want to do. Child labor is something that can be damaging, prevent them from getting an education, those types of things. Let's move now to what companies are caught, what companies might have to start reporting. Cliff, can I turn to you? Can you walk us through these triggers on how do you figure out whether you're a company that has to report?
Sure. The lock and key to the legislation is the word entity. And as you'll see from the slide, it's a fairly complex definition. First of all, the legislation makes it clear that an entity can be any form of legal organization, including an unincorporated association. It's meant to be an exceedingly wide scope application of the term. You don't actually get pulled into the legislation until you meet a series of tests. And so let's walk through some of those tests. One of them is if you're an organization that's listed on a Canadian stock exchange. And it doesn't matter what your size is. If you're immediately listed, you're an entity. Now, if you're not listed, the Act goes through a series of fairly complex qualitative and quantitative thresholds. And let's just look at them very, very quickly in the time that we have. One is, are you a business in Canada in the sense that if you have a place of business, a business address? Or do you do business in Canada? For example, do you have bank accounts or inventory in Canada? Or do you have assets in Canada? And assets are both tangible assets and intangible assets. And if you answer yes to any one of those three things, you have to go to the qualitative tests, the quantitative tests. And the quantitative tests say this, that in your consolidated financial statements, and the word consolidated is used, if in the past 1 of 2 years, you meet 2 of the 3 listed quantitative measures, then you're covered. And those 3 are that you have revenues, assets of 20 million. And those assets of 20 million, again, can be tangible. They can be intangible. For example, goodwill is an asset. And we're talking about gross assets, 40 million in revenue, or 250 employees, both part-time, accounted, full-time. Contractors are not included. But the kicker is that it's global assets, global revenues, global employees. So if a company says, I only have 10 employees here and 240 everywhere else, I only have 5 million in assets here, but 25 elsewhere. I've only got revenues of 8 million here, but 100 million elsewhere. You still meet the qualitative thresholds.
And this is I think this is an important point. So just to recap, if you're a public company, essentially, if you're listed on the stock exchange,
You're
and
covered.
the story, you're covered, hence why we're talking about this for our public company clients.
Yep.
2, so if you're a private company, and these aren't very large monetary thresholds,
No.
but a lot of private companies, if they hit 2 of these 3 metrics, they're an entity.
It's not hard to be caught as an entity, and that clearly is the intent of the legislation. And this is unique in Canada. One, it's unique in the sense that it attracts child labor. It's a prohibited activity that must be disclosed. But the second is, we're not just talking about large companies. We're talking about, for many companies, a medium-sized enterprise. And indeed, you can make the argument some larger, quote unquote, smaller companies will be caught. The intent is to cast a very, very wide net.
And then let's go on to I'm going to go to the next slide as well. Let's talk about the activities that are referenced, and
Sure.
you can touch on this in any order that you want. Like, what do you have to be doing?
Sure. So from the previous slide, but just very, very quickly, if you're an entity and you're engaged in any of the prescribed activities mentioned on that slide, producing, selling, distributing, importing, you have to ask yourself the question, do I have a reporting obligation? And the answer is you do. If you're an entity and you meet one of the prescribed activities, you have a reporting obligation. But the reporting obligation narrows down, and let's talk about that in the next slide. Okay, there you go. So what are the activities that need to be reported on? There's 3. Your production in Canada, your production abroad, and your imports into Canada. So if you've done any of those prescribed activities and you produce in Canada or import into Canada, you have a positive reporting obligation. And what is that positive reporting obligation? And this is where we get into disclosure issues. You have to disclose the steps you're taking at any step in the production, at any step in the importation, to either prevent the use of child labor or forced labor being used, or to reduce the use of child labor or forced labor being used. So you actually have to account for the steps you're taking to reduce or prevent. The law doesn't ask you to eliminate. The law asks you to disclose what you're doing to prevent this or what you're doing to reduce this at any, which means at every single step in your production process or in the imports that you're bringing in from another country. And when you think about it at a very pragmatic level, that's a very, very hard thing to do.
And maybe on imports, the one question I think people have is, if you order something and it gets delivered to you, people always use the Amazon example, but this concept of importer of record, is that relevant to this discussion?
It is at a pragmatic level, but the legislation really doesn't define what an importer is. There is guidance documents for some of you who are aware of this. Public Safety has issued a fairly extensive document. I will say, true confessions, that the document is a bit confusing and contradictory in a couple of places, but ultimately, according to the government and their interpretation of the legislation, you're importing if you quote unquote account for the goods, which is another technical way of saying you have legal liability for the goods that are brought in on your behalf. You have to pay the customs duties. You have to prepare shipping documents. You have to respond to customs authorities. You have the liability for those goods. Even if you use a carrier or a customs broker to manage them, they're doing that on your behalf. So if you're legally liable, you're the importer.
Helpful. I mean, helpful explanation. I'm not sure that it's customers would.
Yeah, it's so you're an Amazon. You buy something on Amazon, they get DHL or they get FedEx. You're the importer.
Understood. So Chris, I'm going to come back to you. So this is a slide from our ESG disclosure study that we referenced, and one of the things that we wanted to do was see, even though the reporting was not mandatory last year, how are companies doing? Like if they had to report the things that are reporting, would they meet the current requirements? It was just a data point we were curious about. Can you help us walk through the slide, what it tells us in terms of how ready companies are, but also I think it's helpful to dig into a little bit on what the reporting requirements are. What are companies supposed to be reporting around this year?
Yeah, sure, Gord. And if this were like a TED talk, I'd get up and walk around and point at the slide, but I won't, just to avoid confusing people coming in virtually. So this is it's a fascinating slide. This is fascinating. These are fascinating statistics in light of the introduction of this and the enactment of this legislation this year. Let me walk you through very quickly what the legislation will require you to disclose as of this spring, and then we'll go through the results of it, just to give you a flavor of how prepared corporations are to report in just a couple of months. So Cliff already touched on the main reporting requirement under the legislation, and it is this. Every year, a covered company is going to need to report on the steps that it has taken to identify, prevent, and eliminate forced or child labor in its supply chain in the previous fiscal year. So it's not just forced or child labor in your operation within your corporate entity. It's not just risk of forced or child labor in your tier 1 suppliers. It's within your entire supply chain. So right down to the ultimate, the very end of your supply chain through contractors, subcontractors, etc. So that's the main reporting requirement. But there is a laundry list of supplementary information that companies are going to be required to report on. And this laundry list of information is quite broad. So it includes things like an obligation to report on the structure of your business, the activities you engage in, and your supply chain. It requires you to report on any due diligence processes or policies that you have in place to identify the risk of forced labor or child labor, and any steps that you've taken to address forced or child labor. It requires you to report on the training that you provide to employees with respect to forced or child labor. Requires you to report on any remediation activities you've engaged in with respect to forced or child labor. It requires you to report on any remediation activities that involve providing compensation to families who have been deprived of income because you've tried to remediate forced or child labor. And last but not least, and I haven't covered everything, I've covered most things, but not everything, but last but not least, it requires you to report on how you judge your effectiveness at dealing with forced or child labor in the supply chain. So these are all required reporting areas that will need to be covered off in the annual report under the legislation. So let's look at what the disclosure study found. It didn't hit on all of these areas exactly, but it touches on a bunch of them. So we see, if you look just about in the middle, you see the bar graphs shoot up to around 60%, just over 60% for the TSX 60, and then around 50% for the CEC 41. That relates to companies disclosing that they have policies or due diligence processes in place in relation to forced or child labor. So that's by far the highest, I guess, hit with respect to current disclosure being made by companies in this area. So around 60%, 65% of TSX companies are reporting that they have policies or due diligence processes in place, slightly less for CEC 41. In all of the other areas, steps taken to assess and manage the risk of forced or child labor, training provided to employees on forced and child labor, steps taken to reduce the risk of forced and child labor in the business and supply chain, we're all below 30%. And so this is current. This is the current level of reporting that's happening amongst major companies in Canada. About 3 or 4 months from now, these companies will need to be hitting 100% to comply with the legislation in these areas. So a lot of work needs to be done in the next couple months to get up to speed.
So two things, one explanation, one comment. For those who aren't familiar with our disclosure study, CEC 41, CEC refers to Climate Engagement Canada. So it's an initiative like Climate Action 100. It's an organization that is engaging with high emitting companies in Canada, and it's selected 41 companies that it deems to be high emitting companies, and it's engaging with them to improve their disclosure. So the CEC 41 bar graph really deals with large public company high emitting companies. So think of those as the more emitting companies. And the comment, I guess, Chris, is what the point is, it's possible that many of these companies have done the work in the background to be ready to report last year, thinking about these issues, but because the reporting wasn't required, they didn't report. That's possible, and that may be the case with many large companies. But it's also possible that if you haven't thought about it, you have 4 or 5 months to think about all of these issues and how you would capture your reporting around here, so that it's not too far away that this reporting is due.
No, it's really not, Gord. And one thing that's interesting and that we've observed just in dealing with clients who are getting ready to deal with this legislation is that the clients who seem to have done the internal work to prepare and are ready to report or are close to ready to report tend to be companies with an international operation who are already covered by comparable legislation in foreign jurisdictions. So, for example, the UK has had what's called modern slavery legislation in place for some years now that requires similar reporting as the new Canadian legislation. Australia also has legislation that's in place, a few other jurisdictions. Companies that are covered by legislation in those areas tend to be just about ready to go. Canadian companies that have no experience reporting in other jurisdictions to put it bluntly, have a lot of work to do to get ready, because ultimately, and I think as we'll talk about later, ultimately there are pretty significant approval steps that are required for this report. You can't just have sort of the human resources manager say, hey, we've done this work and sign off on it. It's a much more serious statement that the company's putting out there. And I think a lot of companies are going to have to work quite quickly in the next few months to get ready to go.
It's a great transition to this topic. And Claudia, I'm going to turn to you for this. This is disclosure. Where does this disclose? Let's talk about disclosure first before we get to the what happens to directors. But where does this disclosure end up? Like, who can look at it?
Right. So an important element of the purpose of the legislation is transparency. It is to be able to have, it's going to be a public facing document. It's meant to get eyes on it. It's not meant to be something that is hidden. And it's based on the basic idea, if there's greater transparency, there'll be greater accountability. And it's sort of the low hanging fruit in the area of human rights due diligence, but we'll talk about that in a moment. So the report that needs to be put together will have to be submitted to Public Safety Canada. Public Safety Canada will have what they've referred to as a searchable database of all of the reports, which suggests it's going to be a bit more than what they have in the UK, which is really just a link to the report. What exactly that'll look like is a little bit unclear at the moment, but that will be available on Public Safety, a government website. In addition, companies are obligated to put it in a prominent place on their website. So it is, again, meant to be something easily accessible by the public and by your shareholders. And speaking of shareholders, if you're a CBCA company, you also need to provide a report, a copy of the report to your shareholders alongside the annual financial statement. So there are really three ways in which this is going to be put out toward the public. And there are certainly members of the public who are very interested in seeing what is going to be in the report. So it's an important element of also the objective, which is transparency around human rights obligations.
So it's publicly available. It's searchable through the government's own resources. But having seen what some of our startup clients do and how quickly they do it, you can see a world in which different organizations quickly figure out how to search this data, how to slice and dice this data, and start producing their own results on how our company's doing. So it's very public. It's very usable, or can be usable in the right hands.
And that is the purpose. Yeah. Good
So,
for us.
so then, knowing how many eyes will be on this, let's talk about director obligations and the process for getting this report approved that Chris alluded to.
Right, as Chris was saying, so under the legislation, the report needs to be approved by the board, by the governing body of the entity. And the directors, one or more directors, have to sign an attestation. We actually now, through the guidance, have what that form of attestation, what it needs to look like, which is effectively attesting to the accuracy of the report, the completeness of the report, which is important. As Chris was enumerating all the areas in which you need to report on, those are all mandatory. They're all obligatory elements that you need to report on. So the attestation is both no a false or misleading, so an accurate report, but also that it's complete. You've covered off all of the areas for reporting. So obviously, in order to be able to effectively do that, again, to Chris's point, there is a lead up to that. This isn't just putting together a report. It is ensuring that you've done the due diligence on the report. You've gone through the process of also ensuring that you've documented your review of the report and have ensured that it is accurate and complete. So it is significant.
Okay, we're gonna go. I'm gonna stay with you, Claudia. I want to go to the next slide here. But before we go to you, Claudia, let me start with Cliff on import bans, and we've talked about this. In the evolution slide, I said, you know, the first step in the evolution is transparency. It's all about disclosure, and yes, this act is about disclosure. But Cliff, it's a little bit more. There's some teeth to it. So can you describe what these import bans are?
Sure. We talked about the legislation itself as requiring disclosure as steps taken to prevent or reduce, and that it doesn't require elimination, which is true. But this act amends certain customs legislation that actually prohibits importation of goods made in whole or in part using forced labor or child labor. The origin of that ban was the NAFTA version 2.2 or 2.0 rather, the CUSMA, the USMCA that was negotiated in July of 2020 that imposed a ban on the importation of goods made with forced labor. But there was no definition of what constituted forced labor. With the passage of this legislation, two things happened. One, that ban in 2020 was moved up to include child labor. And two, it connected that ban to the definitions that Chris talked about as to what constitutes child labor and what constitutes forced labor. And now under this new regime, if you're an importer, you effectively cannot bring in any product made in whole or in part using child labor or forced labor. Because if you do, there's two things that could happen. You can be in violation civilly with extensive amps. You would also be liable under the criminal code provisions as they deal with smuggling. And the problem that we have, again, we've talked about is it's at any stage in the importation. So that if you're bringing in product, you not only have to disclose what you're doing to reduce risk on your importations, you also have to effectively ensure that it's eliminated. And that means you really do need to go through every stage of how that product is produced and satisfy yourself that really it's taint-free of child labor or forced labor. As Chris talked about, those are fairly broad definitions. And so we're talking again about fairly onerous obligations with fairly onerous penalties.
So hold that thought in mind that there are these bans. Now, Claudia, let's go to CORE, the Canadian Ombudsperson for Responsible Enterprise, which I'm pretty sure 90% of the people in the audience have not heard of. Maybe describe what that regime is around, what industries it applies to, and then let's make the link to the previous slide about how accessible all this information is and what that means in terms of CORE's involvement.
So CORE, the Canadian Ombudsperson for Responsible Enterprise, if we recall the third pillar of the UN Guiding Principles, which was at the very beginning, so if you don't recall, that's fine. The third pillar is that both states and businesses have an obligation to provide access to a remedy. So where there has been a human rights violation, there needs to be redress and then the ability to provide remedy. And so under the state obligation, one of the obligations is to have effectively a landscape of both judicial and non-judicial remedy in the area of business and human rights. So CORE, which, you know, the predecessor, if you're in the extractive industry, you probably do have an awareness about this because you've been really effectively most in the crosshairs of the Canadian government policy for a much lengthier period of time than other industries. So the Canadian Ombudsperson for Responsible Enterprise focuses on the extractive, on mining, oil and gas, and now the apparel. It is going to be expanded, but to the point of what it does, it will investigate and take complaints of alleged human rights violations by Canadian businesses, regardless of where they're operating. And it has become much more active in the recent past. You may have seen articles in terms of investigations and complaints received regarding Nike, for example, and Zara Canada. And it is there to effectively provide a non-judicial process for reviewing complaints about alleged human rights violations.
So the reason this struck me, and as I was trying to connect the dots on this, so I went to the CORE website as we were preparing for this, and there's a little button that you click on. It says, essentially, file a complaint. Like you can put in information about something that concerns you. So you have this regime now under the new legislation where all kinds of disclosure is provided. The disclosure could say that you're not sure of what the risks are in your supply chain, as an example. That disclosure is available to multiple parties. People are mining this. There's also a completely different avenue under which complaints can be made. So this starts to become real in terms of the effort companies will have to put in to mitigate some of these risks. I don't know if anybody has a comment on that, but
It's interesting that it's a sleeper, that most people don't look at that, but it effectively becomes a means through the disclosure for somebody to take that disclosure. And if a company says, look, we don't have any policies, we don't have any training, we operate in a region that's known to have a high risk of forced labor or child labor, all of a sudden that sets up complaint risk. And what the core report can do is that report, if there is a finding that child labor or forced labor was used, that can be given to, for example, border officials to seize goods, to do audits. And so all of a sudden you have a complex web of regulation and a complex web of transparency and disclosure that creates risk.
There's a couple of things I want to make sure we hit on before we conclude. So I want to dig into that topic, but I think we'll probably end up doing that at the reception. There's a few things that we should chat about. One is on the evolution slide, Chris, I said this is all leading to mandatory due diligence. Do you want to quickly touch on what is that? What is that more than what's currently required?
It's a very important question, Gord, because, and I'll just I won't bury the lead. The federal government has announced that on top of the new reporting obligations that have just come into force, later this year, we can expect to see a new layer of legislative requirements that will include mandatory due diligence. So that's later this year. We'll see additional legal obligations in this area. But what is mandatory due diligence? Well, in essence, it takes the corporate obligation beyond merely reporting on what you're doing now. It says you don't just need to report on what you're doing now, but you actually need to take proactive steps to look into your supply chain, try and identify human rights risks, in this case, forced and child labor, identify those risks, and then eliminate them, remediate them, and prevent them from happening in the future. So in a lot of ways, it is it's quite a robust corporate obligation to actually look into your supply chain, including your contractors and subcontractors' operations, to look around, try and identify problems, and to try and fix those problems. So in short, goes beyond reporting on what you're doing to actually having to take action with respect to human rights problems in your supply chain.
Okay, so first, get ready and make sure you get your reporting on time, and two, be ready for part two potentially, which is potentially more work to do. Cliff, I think you touched on this. I don't know if you want to add anything to international companies with international operations, how they're thinking about this. What should they be thinking about? Yeah,
sure. And very briefly, there's a couple of things that can be done. One is at a contractual level, and you want to revisit your contracts with your suppliers. And just looking at my notes on some of the things you want to have, you want, for example, to specify that they're not going to purchase goods from certain regions that are known to carry risk. You want to be able to build into your contracts the ability to do both audits and site visits. And you may also want to build in that they will carry the risk of loss. If, for example, Canadian border officials say goods have been produced with child labor or forced labor, we're seizing it and we're going to destroy it. And then finally, you may want to have in your contracts rights of termination if you have reasonable indication of forced labor or child labor taint in any of the products that you're getting. But then there's also non-contractual things you can do, which is engage in due diligence reviews of your suppliers. Just actually interview them, find out how they operate, and find out if they have an idea of what their supply chains are. And then, of course, develop pretty comprehensive codes of conduct dealing with forced labor, child labor, and ask your suppliers to mimic those. And then finally, and it just sounds very, very trite almost, but it really isn't, it's training. and it becomes a whole of corporate organization that everybody involved just needs to understand what the obligations are, and to ask your tier one suppliers to participate in that training so that they're on the same same wavelength as you. Sorry.
Thanks. That's helpful. The last 2 points, I was going to have a broad ranging discussion, but I think I'll conclude with you, Claudia. And that is, when we think about the legislation that we have, the idea that it may be expanded to include mandatory due diligence. Any closing remarks on, does this change if there's a change in government? This whole anti-ESG movement, particularly in the US, does that change where this is going? Is this like, if we just wait a year, it's all gone, we don't need to worry about it?
Well, no, but on the government, in terms of the Canadian political context, there was no opposition to the reporting legislation, and both the Conservatives and the Liberals in the last election had it part of their platform to address issues around forced labor and child labor. So there isn't really a lot of differences between the parties when it comes to the reporting legislation. The fault line that we did see was that the NDP and the Bloc, for example, wanted more. They wanted the mandatory human rights due diligence. So the only possible, where it may not move as quickly would be around mandatory human rights due diligence, and when in fact we're going to see that. But I wouldn't bank on any of that. I think we are in an era where I think it is going to continue to move in this direction. Notwithstanding that there may be some headwinds, that this is where we're moving toward.
Okay, I think we're at time, but there's a couple of questions that came in. Let's see if we can hit at least one or two of these quickly. I assume stock exchanges include venture exchanges. Cliff, I think the answer would be yes.
Yes.
There's a specific question here for you. Under the exceptions, does the Act apply to financial institutions? Is that an easy answer? Is that a complicated answer? Cliff, do you have one for that, or do you want to?
Sorry, I didn't catch that again, please.
Are there any exceptions for financial institutions? And I'm not sure that.
So financial institutions, if you're pure service provider, in other words, you're engaging in issuing letters of credit, loans, credit facilities, whatever, that action itself is not caught, even if you're associated with somebody that's producing or manufacturing or importing. In other words, if you're providing letter of credit to affect the importation, you're not sucked into it. But if you, as a financial institution, are bringing in any items from abroad, and some financial institutions, in fact, are, then you're caught.
There's a similar question around service companies, software as service companies, similar analysis for those types of companies.
Similar analysis, because if you're a software company, let's say, for example, you're bringing in computers, and where are those computers coming from? And let's say they're coming from Indonesia, Malaysia, the United States. That immediately makes you an importer. So notwithstanding the fact that you're engaged in 3D drawings, whatever, software development, the fact that you're bringing in those computers puts you at risk with respect to your obligations, and actually requires you to comment on that supply chain, the computers that you're bringing in.
Okay, thank you. I think we're going to have to leave it there. So we can move to our second panel. For those in the room that if you have questions, we'll all be here at the reception. So please feel free to stick around and pepper us. And to our panelists, Cliff, Chris, Claudia, thank you so much. So we're just transitioning into our second panel, and let me welcome our panelists for our second panel. So first we have with us Lisa DeMarco, Lisa is a senior partner and CEO of Resilient LLP. She has over 2 decades of experience in law, regulation, policy, and advocacy relating to energy and climate change. She's a leading climate change lawyer who's active in both the legal and policy aspects of climate change. She participates in UN negotiations and was most recently at COP28 in Dubai. Lisa, welcome. We also have Emily Bundock. Emily is a partner in Fasken's Montreal office. She's a member of the Energy and Climate, Mining, and Indigenous Law Practice Groups. She's based, as I said, in Montreal. Her practice focuses primarily on energy and natural resources development projects and on environmental law. She advises clients on matters relating to Indigenous law, such as consultation and drafting and negotiating agreements with Indigenous communities. Emily, welcome. And Emily is kindly agreed to step in when our colleague Pierre-Olivier was not able to participate. She was supposed to join us in person, but due to the weather yesterday, was not able to make it in. So thank you for being a trooper and being online.
Pleasure. And I must say, I'm kind of saving 0.4 tons of CO2 equivalent by staying here in Montreal.
Well done. Well done. So to kick off, in the last panel, Lisa, we talked about how the UN guiding principles on business and human rights was kind of the starting point on the road to disclosure around business and human rights issues. I think that when we talk about climate change, it seems to me that the Paris Agreement is probably the starting point for most of the discussions that are happening now. But I'm not sure most people understand exactly what happened in the Paris Agreement. People tend to use Paris Agreement and 1.5 degrees Celsius kind of all in the same sentence. I'm not sure everybody understands what the 1.5 degrees Celsius is about. Can you walk us through what the agreement was, what the relevance of 1.5 degrees is?
I can, and I'm really struck with how dovetailed and smoothly the last panel flows into this panel, because in that context, we really have reporting 1.0, and here we're getting into reporting 2.0 in the climate change context. So the origins, as you asked, really do arise from the Paris Agreement. And you'll see the substantive text of Article 2, Section 1, subsection A, refers to that 1.5 degree number. It's actually a commitment to hold the increase in global temperatures to 2 degrees with a view to 1.5 degrees. And there are other obligations relating to adaptation and financial flows. So that's what the start of the genesis of climate reporting was. And it's really amped up from there. That was in 2015. If we can move forward to 2018, further science and research was done by the Intergovernmental Panel on Climate Change. And it found that we're already seeing the impacts of 1 degree warning. We've hit it already. And so there was a big push to say we must limit warming to a maximum of 1.5 degrees Celsius prior to 2030. That required rapid and far-reaching solutions. And then most recently, a few weeks ago, coming out of the UN negotiations, you see the further iteration of the obligations agreed to by the parties, with the key element that was hotly negotiated by John Kerry and Minister Guilbeault and many of the ministers of the parties to the United Nations to agree to accelerate net zero emission energy systems and transition away from fossil fuels in energy systems, very important qualifier, in energy systems in a just, orderly, and equitable manner. So you can see how we started in Paris in 2015. Science got more definitive. In 2018, we got further obligations. And now the focus is very dramatically on fossil fuels.
Okay, so that's helpful. So we know that nations are making these commitments in these treaties like the Paris Agreement. What do they then do in their home countries? What do they do in their local jurisdictions to give effect to those commitments? Presumably they pass laws. So Emily, walk us through in Canada, how are those international commitments reflected under Canadian laws?
Yeah, so the answer is yes, we have laws in Canada. And for the most part, Canada has elected to rely on market-based initiatives to actually lower the greenhouse gas emissions and meet the objectives that were made as part of the Paris Agreement. So there are other policies that the government of Canada has implemented, such as you may have heard of the 2 billion trees program. So that's all part of the action to reduce greenhouse gas emissions. But at least since 2019, there is like a Canada-wide approach to reducing greenhouse gas emissions, and that's through the federal carbon pricing legal framework, which operates as a backstop depending on how each province elects to regulate this space. So you can look at the next slide, yes, this one on the screen, that it's a bit piecemeal. So it really provides the flexibility to each province to actually either adopt its own carbon pricing system or to have the federal one applicable to the jurisdiction. So the federal pricing system has two parts. The first one is a regulatory charge on fossil fuels like gasoline or natural gas. It's known as the fuel charge, and it's administered by the Canada Revenue Agency. The second part of the system is a performance-based system for the industrial sector. It's known as the output-based pricing system. And so one or both parts can apply to a specific province. So both parts of the federal pricing system, as you can see on the map, will apply in Manitoba, Nunavut, Prince Edward Island, and the Yukon. The federal fuel charge only for the federal mechanism applies alongside the provincial carbon pricing system for the industrial sector in Alberta, New Brunswick, Newfoundland and Labrador, Nova Scotia, Ontario, and Saskatchewan program. So that's for those let's say dual system provinces. The other variation is a carbon pollution pricing system. So in British Columbia, Northwest Territories, and Quebec, currently those systems continue to meet the federal, let's say, benchmark. And so the requirements that were adopted in those provinces are deemed sufficient to remain active and not import the federal system. So in Quebec, it's known as the cap and trade system for greenhouse gas emissions allowance. Maybe move to the next one.
Yep, this one.
Yeah, just to give you an idea that around the globe, there are emissions trading schemes and carbon taxes or carbon charges or carbon levy. So basically regulated charges on carbon. So some sort of a carbon pricing mechanism that applies in many, and let's say a growing number of jurisdictions in the past few years.
Okay, so that's a really helpful background on what the legislation is in Canada, what the frameworks are in Canada and worldwide. What I find remarkable, though, is that when companies are setting targets for themselves, and these targets aren't necessarily required by any specific legislation. And I want to go to our study for a second, and this just gives you an indication of the kinds of targets that are being set. So this says that over 60% of the companies that we looked at, these are large companies, are referencing an absolute greenhouse gas emission reduction target. Some of these companies are also referencing a net zero target. And the next slide shows how these targets are being set by various, it's the same data point, but on an industry basis. So this is purely voluntary, it seems, that companies are setting targets for themselves. And so I want to understand, Lisa, maybe I'll start with you. Why are companies doing this?
There are many reasons, and in particular, those reasons are evolving. And so that's an asterisk. If we want to definitely do an exclamation mark behind that point, those reasons are evolving. Initially, it was seen as good for products and marketing. Now, we're having some challenges. We're having greenwashing related claims associated with some of that marketing. A more recent motivator for such target setting is stakeholder demand. In particular, many of the financial institutions around the world have joined the Net Zero Banking Association or one of the industry associations under the Glasgow Financial Alliance for Net Zero and set their own targets, not just for their own emissions, but for the emissions in their supply chain, both upstream and downstream. So you're seeing the commonalities between your two panels here. The supply chain is becoming more and more important. And if a financial institution has an obligation to report on emissions in its supply chain, it's going to demand that you, as part of their financed entities, disclose what those obligations are and set your own targets. So that's a very significant motivator. Also, this isn't all about liability. There are opportunities associated with greenhouse gas emission reductions and removals. And in particular, there is a revenue stream. If you can efficiently reduce or remove greenhouse gas emissions that many companies are realizing. And so that's very important. And last but not least, again, parallel with your last panel, what's happening at the border makes a difference. And as of January 1st this year, we have the European Union implementing its CBAM program, Carbon Border Adjustment Mechanism. So a border tariff based on the emissions and the associated carbon pricing of certain goods that are imported in the jurisdiction in attempt to put their suppliers and producers on a level playing field with the imports. So lots of changing and new motivating factors. I would put a big star next to marketing because not so much right now.
So emissions of carbon not going away. This is why companies are focused on it, and many of them are setting targets based on what they're emitting. So then that takes us to this concept here. Setting a target is one thing. If you set a target, you want to know whether you are going to achieve that target. So you need to keep track of things. But then why do you go further to then actually disclosing these things? Why are companies actually disclosing their emissions? And I'll share a couple of slides to make the point. Actually, I'll come to that slide later. It is coming up. But Emily, can I turn to you? What is driving companies to do these reports?
So I think in many sectors, first, there's a big push for transparency. And the push for transparency is coming from investors, suppliers, customers, also from employees. So there's a lot of employees want to feel that their employer is actually doing something. They want to know what their what their employer is committing to. Reporting creates that improved transparency. It enables businesses to actually show their commitments to sustainability, to build trust with customers, with investors, with other stakeholders. So I think there's definitely a push for that because people and businesses see that it is, giving them the results that they want. Don't forget that also disclosing greenhouse gas emissions, as Lisa mentioned, it's not only doing something good for the environment, it's also becoming more and more about risk management, cost efficiency. By disclosing and measuring performance, businesses can identify emerging environmental risks and opportunities that otherwise may have been overlooked. So that's a big part also of what reporting can bring to a specific business or companies. And then, of course, regulatory reporting requirements, when they come along, play a big role in enhancing that transparency. And keep in mind that those businesses that today are already subject to some rules about their climate disclosure. They have a lot of knowledge about their climate data. And so that's at some point, it's going to create, I think, a smarter, like a climate smarter environment for business.
I want to touch on one thing that you mentioned, which is risk mitigation. And the one thing that we often, when we're talking to boards of directors, the one thing we often highlight to them is it doesn't quite matter what today's environment is around carbon emissions and what your views are really. If you look 10, 15, 20 years into the future, and you look at, just take society as a general, you look at society sentiments now, you look at a 20-year-old, a 30-year-old, you look at what positions they'll be in 20 years, and then you start to ask yourself, is the risk that there is a cost of carbon, is there the risk that I have to pay for greenhouse gas emissions? Does that risk stay the same? Does it go down or does it go up? And if you think that that risk potentially goes up, you probably should start thinking today about how you're going to handle that risk. And that is really what is driving a lot of companies to try to get ahead of figuring out what their greenhouse gas emissions are and how they manage it. Lisa, I want to ask you for any perspectives you have on this before we move to the next slide.
Yeah, maybe just a point of emphasis on that too. Many companies are strategic planning over 20, 30-year time horizons. And so that's critical. But then also they're making investment decisions today on 60, 70, 100-year assets, on products and pathways of production that are long-standing. You may not want to strand an asset because you didn't consider the climate-related aspects. You may not want to forego an opportunity because you did not consider the associated emission assets. And I've told the story before, you've heard it. One of the most challenging pieces of work that we've had to do is we were called in by a board of directors who said, can you have a look at this? Did our team really forego a $100 million a year revenue stream by not considering carbon as an asset? And unfortunately, the answer was yes, they did. And so this is something to think about, both sides of the equation, the liability side and the opportunity side.
A very good point. So I'm going to pick on the regulatory reporting requirements item that you mentioned. That's going to take us into the next discussion. So let's do a scan of what the regulatory reporting requirements are around climate disclosures. Lisa, can you start us off? Just give us a big picture. What is, what's going on in Europe? And then Emily, I'll turn to you to talk a little bit about the US and Canada.
I'm going to give you a two-word answer to what's going on in Europe. A lot. Very significant number of reporting initiatives and guidelines that are motivating things that we're seeing today. So we've seen what was originally the non-financial reported directive looking at really corporate sustainability practices. That's morphed into the corporate sustainability reporting directive, now in effect in the EU, with a number of elements of related sustainability reporting and climate related reporting that's informed by the EU taxonomy. We don't have the Canadian taxonomy yet. Purportedly it's due in the next 2 months, but certainly we expect to see that forthcoming. And that's informed by a number of guidance documents and a EU Green Claims Directive. The UK has its own Green Claims Code. France has specific prohibitions on the use of certain terms and its Climate and Resilience Act. And a lot of these really get to the nub of make sure that you can back up with fact and evidence and disclosure what you're claiming in relation to your product or your sustainable investments. And I would be remiss if I didn't mention the claim issued yesterday against the 5 Canadian banks to attempt to facilitate an investigation by the OSC and the AMF in Quebec to push them to investigate how they're using the term sustainable finance. and see if it in fact is worthy of a greenwashing claim. So it isn't just in Europe, it's here as well that we've got significant greenwashing claims motivating enhanced regulatory obligations, also California as well, around reporting related to climate.
Can you go back and make the point again about taxonomy and this whole concept of when you say a word around climate change, when you say sustainable, when you use carbon neutral, what does that mean? I want me to make that point about taxonomy and where Europe is at and where North America is at.
Europe is far, far further down the road of saying precisely when you use this term, this is what it means. And if we can go to your study, you had two terms around historically, the last couple of slides, carbon neutral versus net zero. Now, the IPCC and people who live in the world of climate change every day have defined terms governed by the Paris Agreement around that. But the general financial marketplace uses those terms in dramatically different ways. And the EU has attempted to narrow the ways that they use those terms by putting forth a taxonomy. This is what it means when you say net zero. This is what it means when you say carbon neutral. And in that way, it provides restrictions, but also some protections for companies who are using the terms properly. In Canada, we don't have that yet. We don't have a definition of, for example, sustainable finance. And hence, we have a claim yesterday for using the term sustainable finance. So these are issues that we really need to get on with.
And what I find remarkable about this is, as an M&A lawyer, when we look at North American style M&A agreements, it is our practice to define every single word we use in great detail. Some of the definitions are a half-page long. The European practice does not do that. The Europeans are much more about conceptually describing what they're buying and selling. But when it comes to climate change, we don't have a good set of definitions that we've subscribed to in North America. And then it results in lots of uncertainty as to what words mean and what companies think they mean and what a person bringing a claim against a company might think it means. So let's let us catch up here and come back to Emily. Usually when we think about Canada and its position in the world, we always think of ourselves as Goldilocks, somewhere between Europe and the US. But when it comes to the climate disclosure rule that was proposed by Canada and then the US, in some ways it seemed like the US might have gone further than Canada. But do you want to give us a summary of what each of the proposals had, and then we'll talk a little bit about where those proposals stand.
Sure, and the delay that we're seeing in the Canadian proposal is actually a result of the delay in the US. So what you're saying is actually really, really true. So the first one is the SEC, so the Securities and Exchange Commission disclosure rule on climate. It was delayed once again. So it was delayed in the rulemaking process. The first iteration that was published in March 2022, so the proposal of March 2022 is, to be finalized probably somewhere this spring. The SEC has delayed the final action a few times already, and the latest delay is kind of I would say maybe a chilling effect or a pushback by some public companies against some of the more onerous proposed requirements, including Scope 3 greenhouse gas emissions. So we'll define that later. But so the first big chunk of that rule is the disclosure on Scope 3 greenhouse gas emissions, the 1% materiality threshold for financial statement disclosures, and the attestation of Scope 1 and Scope 2 greenhouse gas emissions for larger companies. So the pushback comes from those more stringent requirements in the SEC climate disclosure rule, the proposed version. In Canada, the CSA published a request for comment in October 2021 on a proposed national instrument, number 51107, so disclosure of climate-related matters, which was incorporating basically a lot of what the Task Force on Climate-Related Financial Disclosure Framework was proposing. And the rule is currently being reviewed in light of other amendments and proposals, including the SEC Climate Disclosure Rule and the new or more recent International Sustainability Standards Board framework. So those are the two elements or items that are actually slowing down the process in Canada. And one of the drivers for those instruments, at least the SEC and the Canadian proposal, is to improve the quality of the disclosures. Because at the moment, there's a variety of frameworks, of guidelines that companies are using to actually prepare their disclosures. And it's on a voluntary basis. So there's a lot of discrepancies between what you can see in a report and in another report, although we can argue, and our study shows that there's a certain number of companies that kind of adhere to similar frameworks. But that's one of the drivers. So having a national instrument that would be mandatory to the group would make things easier. And I think you had that we have that in the study, and we have it in one of the slides to show who's using which framework, so that it can be, yes, it can be easier for the audience to see the number of companies that have actually adopted which framework. And so, of course, our study is based on the disclosures that were made for the financial year of 2022, ending December 2022. So what you see in the first column, the SASB one, is so what I was referring to, the ISSB, the new ISSB framework is derived from both the SASB and the TSFD framework. So it would probably be convenient for a lot of companies to adopt this new standard. But one point about the ISSB rules is that it has, for now, it has two parts. A part, yes, on climate, but another part that is more generally on sustainability. So it goes beyond just the climate reporting. And so that would be what I would say about where the US and Canada stand, Gord. I don't know if you had.
That's helpful. I'd like to maybe just mention two things. So for companies, public companies in Canada that have already been reporting under TCFD, or tracking their disclosures around TCFD, because that was what was in the Canadian proposed rule, not to worry. ISSB is kind of subsumed TCFD. So if you're in compliance with TCFD, you should be fine under ISSB. The other point I wanted to make was under the SEC was supposed to come out with the final rule April of last year, October of last year. Now it's pushed to April of this year. When you hear people in the US talk, what's likely going to happen is it might be delayed past April, but there's an act in the US called the Congressional Review Act, which essentially allows a new Congress to kill any regulatory rules that were enacted under the previous government. And there's a 60 legislative day look back period for that. So on the assumption that the government could change and it could be a new Congress in the US at the next election, the SEC's probably got this in mind. So sometime this year, before that look back period kicks in, is likely the end date by which the SEC will end up for publishing this rule. Before we leave the slide, Lisa, maybe just a couple points on the last one on consumer protection legislation and how California's come at this.
Yes, we've had a flurry of bills, one of which was vetoed at the last minute in California around facilitating consumer protection through really prescriptive disclosure requirements around your use of carbon assets. So AB 1307 and a series of companion bills in the Senate have really pushed, from a consumer protection perspective, the whole concept that the consumer must be protected from fraudulent claims around or lack of information around what type of product, emission offset or other form of product you're using to make the claim that supports what you're doing. So whether you're making a net zero or a carbon neutral claim, and if you're using any offsets in relation to your own compensation claims, how you're using that. And we have a number of voluntary instruments that are helping with that as well.
Okay, so takeaway, in Canada, there will be a disclosure rule at some point. It'll likely come in after the SEC publishes its rule. The SEC is almost certain to publish its rule at some point this year. So all of these things that we're talking about in terms of getting ready for disclosure, it is relevant for companies to be considering this year. So let's go to this slide. So this is the heart of disclosure. Emily, can I start with you? Maybe just describe to us, some of us know what they mean, not everybody does, but distinguish for us, what do we mean when we say scope 1 or scope 2 and scope 3? You mentioned what the requirements are under the US and the Canadian rules, but describe these for us. And I can go to the next slide whenever you want me to.
Sure. So scope 1 is to identify direct emissions that occur from sources that are owned or controlled by the company. So think, for example, emissions generated by an industrial process such as melting metal, a smelter. So that's really scope 1 emissions. Scope 2 emissions are indirect greenhouse gas emissions that occur from the generation of purchased electricity, heat, or steam consumed by the company. So electric consumption to light and heat your business premises would be a scope 2 emissions. Scope 3 are indirect emissions that fall outside scope 1 and 2, of course, and that occur in the supply chain or the value chain, upstream or downstream. So you're taking kind of your impact as a whole. An example is waste that's generated in company operations. If you don't control the actual handling and management of the waste. So if you don't control the management facility, the waste management facility, waste would be considered scope 3 emissions. Emissions from your employees commuting to and from the office is another example of scope 3 emissions. And another one that is really that is a source of headaches for a lot is a company's investments. So companies' investments are also considered, so emissions from companies' investments would also be considered scope 3 emissions. So in this slide that you're showing, Gord, you have basically the 15 different categories of scope 3 emissions that you can look at, and just by reading the list, you actually understand kind of the challenge of capturing and measuring those emissions, which means you'd need to have something in your dealings with any counterpart, whether it's your employees or customers, to be able to collect that data if ever you have to report on that data.
So the US rule in the original proposal, I think, mandated scope 1 and scope 2. It mandated scope 3 only in limited circumstances, I think. Canada did not have a mandate necessarily on scope 1 and scope 2. We'll wait and see what happens. If the US has a mandate, we'll see what the Canadian securities regulators do. So Lisa, let me turn to you now. So we have companies setting targets. Maybe it's a net zero target, and they're tracking their scope emissions. How do carbon markets enter the picture for most companies then?
Many companies have turned to carbon markets and emission reductions, either in the form of a voluntary offset, which is an emission reduction or an avoidance, or a removal, which is an actual removal of CO2 from the atmosphere, to make claims around, we are achieving our target. We are meeting that carbon neutral or net zero target. And there's been some pushback around that, largely around what's known as the Science-Based Targets Initiative, which was originally meant for setting targets, but is being used for evaluating compliance. And the big part of the SBTI, the Science-Based Target Initiative, that's causing the controversy are statements that say you can't use emission reductions and avoidance for compensation claims. And so in order to address this, there have been a slew of integrity initiatives, carbon offset and removal supply initiatives, what used to be called the Task Force on TCFD. It's now called the Integrity Council for the Voluntary Carbon Market Initiative. That's supply side. Demand side is the Voluntary Carbon Markets Integrity Initiative. They came up with a claims code to help out companies who wanted to credibly make claims and not get sued. And then we're seeing actually the G7 come up with a carbon markets platform integrity initiative to try and look at the trading systems themselves and the requirements that they should meet. So lots of initiatives all around integrity that dovetail with the transparency requirements and the associated integrity requirements that we're seeing.
Okay, so let's catch everybody up. So we went from companies setting targets. Because they set targets, people want to know how they're tracking. So the companies are keeping track of their emissions. They're now disclosing some of those emissions because investors want to see it. What happens if that disclosure is not right? How do you know whether or not that disclosure is right? And this is one thing that we've been having conversations with companies about for the last year. Are your internal control systems in place to help you vet whether or not these disclosures are accurate? Companies are really, really good at having internal controls over financial reporting. But are you comfortable enough that those internal controls are also good enough to track GHG emissions reporting? Some companies, in order to help them be comfortable that their reporting is okay, are getting third-party assurance. And I want to go to so this slide shows you from our study that quite a few companies are getting third-party assurance on at least parts of their ESG disclosure. So this gives the board comfort, this gives the companies comfort that somebody else is kicking the tires on whether their disclosure is right. So this is going to be a continued topic of interest, I think, for public companies this coming year. So if you get your disclosure wrong, what happens? Emily, you want to chime in on, well, actually, I'd like both of you to chime in on the last point about what the risk is around getting it wrong.
So it's interesting because Lisa, you mentioned we had there's this a complaint that was filed yesterday about the use of sustainable finance by some of the banks here. And so I think one of the drivers, if you want, of those complaints or litigations, but sometimes they don't necessarily go to litigation, is to kind of shake a bit the businesses to make sure that whatever commitments they make, they actually can walk the talk. And so there's a lot of that. It is still about reputation. And so the risk is huge in terms of just your reputation, stock price. So that's something that we hear a lot from our clients in terms of just the reputational stage. Because in Canada, so far, we have not seen as many cases like there are more, let's say, in Europe. But there is certainly a risk, a very big one on reputation, and more concrete litigation risk. Competition Bureau investigation also. So that's coming I mean, it's current, but it's, I think, increasing in the past few years. And it's probably an indication of climate as being a topic that is of interest in society in general. It was very big when BlackRock made that first statement about climate risk as financial risk a few years ago. So I think at that time, environment in general and climate in particular moved from being very peripheral topic, or not very, but more peripheral topic, to being core of governance. And so now you have ESG and you have governance around climate that we did not see before. And that's because there is a risk. So risk management is becoming something around climate.
Lisa, any concluding remarks around the risks around this?
I think the risks are aided and abetted by policy and regulatory uncertainty. So even if you do get your disclosures right, which I would argue the banks have done a pretty decent job, particularly in the absence of regulatory guidance, they've adhered to the standards internationally set by the net zero banking associations. You're not guaranteed that there won't be a claim. And many times those claims are based on ideological views, trying to push a policy agenda through a litigation initiative. So from that perspective, dotting the I's and crossing the T's in advance puts you in a far better, stronger position to easily and quickly dispense with those claims.
Okay, we're at time. What we're going to do is conclude with one last comment from each of you. You can't have a conversation about ESG without talking about the anti-ESG movement. I used to say, if you're down in the US, you can't say the word ESG without expecting to get punched in the face. It's probably gotten a little bit worse last year in the US, not so bad here in Canada necessarily. But maybe just talk a little bit about where sentiment is at generally. People have been wondering whether BlackRock is backtracking. People talk about this green hushing concept. So maybe I'll ask each of you to make a comment on this. Emily, I'll start with you, and then Lisa, I'll conclude with you. Emily?
So I don't think we'll reverse in terms of like we're so far into the climate initiatives. So I don't think we'll go back. I think there might be partly economic cycle reasons. So we've seen the economy not being quite as let's say successful in the past year or so, and very often that can have an effect on those initiatives that are seen as more progressive in a specific agenda or priorities for businesses. So that's one comment that I don't think we'll go back. I think there's just a readjustment. The other thing is it's going to become, I think climate is going to become more of a one of many topic kind of thing. So it was relatively new for businesses to consider climate. I think it's going to become more kind of a mainstream topic on a business risk management perspective. And that's thanks to a lot of the ESG movement that is clearly integrating this into financial analysis, business analysis as a whole. So that's, I think, something that I think is promising. So I don't see, and I hope kind of thing that we're not going back.
Lisa, last word to you.
Yeah, I would follow the money. And the money is not retracting from ESG related disclosures. I think the political environment in the US is a sideshow. And we'll have the BlackRock Tennessee case play out as a sideshow, but money is not retracting. And if you look at the breadth of the Glasgow Financial Alliance for net zero, you've got insurers covered, asset owners covered, asset managers covered, banks covered, pension funds covered. Follow the money. It's not going anywhere but towards enhanced ESG related disclosure. I will say they're getting a lot more precise about exactly what they're disclosing and how they're disclosing it. And that leads to some green hushing around leaving things out of the disclosures if they can't substantiate them factually and with sufficient evidence so that the CEOs and related CFOs can breathe easily.
I know we could keep going because some of these topics require us to dig even deeper, but this has been a great start to the discussion. I think we're going to leave it at that. Lisa, thank you very much. Emily, thank you very much. I'm going to draw our panels to a close. To our audience online, please stay tuned for follow-up emails from our Fasken team. Feel free to go to our website to download the relevant materials that we've had. And for those in the room, we welcome you to stay for our reception. You can corner any of our Fasken colleagues or Lisa to pepper us with questions. And to all of you, we wish you a very happy and successful upcoming new year. Thank you very much.